Hello, and welcome to another episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So I would like to begin by first apologizing for the last two sessions of the Market Pulse. I haven't been able to present in the sessions, but thankfully we are back, and hopefully we are going to maintain these sessions as usual. So if you can hear me clearly, kindly type hi on the live comment section, and these will confirm that everything is working just fine. So hello, Philip. Thank you for joining the session. I always appreciate your feedback. So today we are going to take a much longer term outlook at the markets. So I know that we normally hold what we call the market snapshot series, and this happens on every Monday to Thursday at 11 a.m. And during these sessions, we take a very short-term outlook of the markets, which is basically looking at what happened yesterday, what's on the economic calendar today, what are the key price levels today, and it's often very short. So during the Market Pulse series, we try to get a much bigger outlook, try to understand what's currently happening in the markets. And once we cover these, then it becomes easy for us to establish bias in the markets by knowing what's happening with the major central bank policies, what's happening, or what are the key risk factors that investors are considering in the markets today. So the first highlight of the day, as we all know, is that the SEC, or the Securities and Exchange Commission of the US, is basically cracking down on crypto companies in the US. And some of the immediate recipients seem to be Binance, the trading giant, or basically the crypto giant. And of course, we also have Coinbase, which is a company that is currently listed with the NASDAQ exchange. So with the SEC cracking down on these cryptocurrency companies, we know that the immediate outcome, especially for us traders, is looking at Coinbase shares and how they have been performing. And clearly, we have seen fear happening in the markets. So I'll be looking at this right away. So, well, the number one thing that has been supporting the stock markets this year has been AI, or artificial intelligence. We know that crypto companies have been quite suffering as a result of major news happening across different exchanges. So if you look at the year-to-date performance for Coinbase Global, it's been up 59.46%. However, with the news that are just coming up with the SEC cracking down on both Coinbase and Binance, we know that anything could come out of this. So right now, it's a major market risk for this stock, which is up 59% year to date. And also, it's also a major risk factor for cryptocurrency traders. So we know that the SEC is looking to pass several cryptocurrencies as unregulated securities. And if this goes forward and passes through the United States legal system, then it basically means that a majority of the exchanges will either be fined, shut down, or we could be seeing something completely different. So it's a risk factor that we should be worried about. So the other key risk factor is Canada. We know that in Canada, they normally have these annual wildfires. The wildfires are quite common, especially in countries where they experience seasons where there is extreme heat. So I remember in December, January 2020, we had wildfires ravaging through the country of Australia, and these had an immense impact in the markets. So right now, we are having a very big outbreak of wildfires happening in Canada. It's the worst outbreak they have ever seen in terms of fire burning up thousands and thousands of kilometers squared. And as a result of this, what we are seeing is unprecedented. So due to the strong winds that are currently happening in Canada, the smoke coming from Canada is actually covering the skies in Northern America. So if you look at the US, there's a lot of smoke right now happening in the entire North America. And already we are seeing air being polluted, and major air pollution signals are already up. So it's becoming quite a nuisance. Of course, in the province of Quebec in Canada, there's a massive movement of people. People are being moved from those areas where there's extreme fires, and it's developing into a much bigger situation. And now the markets are concerned. It has become a market risk. So those are two of the key things that are currently happening in the markets. So the third one, as we know, the US has been grappling with the problem of the debt ceiling limit, which had been set at $31.4 trillion. So over the last couple of weeks, the markets were largely concerned about the US defaulting on its debt, which was set to happen by the 1st of June. However, the Democrats and Republicans were able to come and agree to a deal where they suspended the debt limit by 2 years. So for 2 years, the US will be able to borrow an unlimited amount of money up until the debt limit suspension comes due in 2025. So with this in mind, now investors are no longer worried about the US defaulting on its debt because it's no longer limited by its own laws. Now they can borrow unlimited. And with this in mind, what investors are now focusing on is the Central Bank of the US, or what we call the Federal Reserve, which is set to have a meeting mid next week. So the meeting will be the FOMC press conference. Usually happens a couple of times, about 8 times in a year. So when you go to the economic calendar, I'm going to do this right away. So it's not this week, it's going to be happening next week. So next week on Wednesday, this is when we'll be having the FOMC economic projections. We'll be having the FOMC statement, the federal funds rate, which is basically a vote to hike or maintain interest rates or even cut. Cutting is out of the woods. It's not something that is actually being considered. So the two major decisions that the investors are trying to determine is whether the Fed will maintain interest rates at the current level of 5.25%, which is basically a limit between 5.0 and 5.25%. So the other option is that the Fed could potentially hike interest rates by 25 basis points. So we could be seeing this decision happen where interest rates could move higher to 5.5%, or they could be maintained at the current level. So with this in mind, we know that if interest rates are hiked further to 5.5%, the result in the market would be, on one side, the dollar would become really strong, and a very strong dollar would be very easy for any trader out there to participate in the markets by basically buying the dollar against other currencies. So on the other hand, when you look at US equities, they could take a big hit as a result of higher interest rates. So there is a good chance we could be seeing the Nasdaq, the Dow Jones, and the S&P 500 start going down as a result of a much stronger rate hike. So on the other hand, if the Fed was to maintain interest rates at the current level of 5.25%, that would be the first time the Fed is doing this since March last year. So in a period of 15 months, the Fed has been hiking interest rates every time they sit down. So if they happen to keep interest rates level, then it would raise confidence that interest rates have at least achieved a major target, which is what the Fed chair has been describing as a restrictive level. And in this level, it basically means that they feel like they have done enough. Now they are buying time to see if inflation gets back towards the 2% target level. So as it stands, we know that inflation peaked in June last year at 9.1%. And since then, it has been going down every month. And in the most recent reading, US inflation was at 4.9%. So at 4.9%, there's still more room to go down towards the 2% target. So it's still high by about 2.9%. So inflation data for May will be coming up next week on Tuesday. So before the Fed announces the interest rate decision on Wednesday, they will have one more data point to consider. And this is the consumer price index, which is basically the overall measure of inflation in the US. So in the last reading, inflation was 4.9%. Analysts are estimating that inflation will have dropped in May by 4.1%. So the outcome of this data point will determine whether the Fed will go for a stronger rate hike or whether they will maintain rates at the current level. So if there's a big spike in the CPI, let's say we see 4.9% or even anything higher than that, then the overall outcome is an expectation that the Fed will go for a rate hike. However, if it's consistent and goes back down to 4.1%, then perhaps there's a chance that the Fed will consider holding rates at that level. So that's very, very important to understand. So the key concern for the Fed over the number of speeches they have been doing over the month of May is that they are looking at a very hot job market. So a hot job market basically implies that there's more companies looking for employees than employees looking for work, which creates a very tight market where unemployment keeps getting smaller and smaller. And of course, the money in people's pockets keeps getting higher and higher. So if every other company is looking for employees and there's few employees, then the wages tend to rise very fast. And as long as people has more money, then they tend to spend more money in the economy, which has the immediate result of making the inflation much worse. So in economic terms, we normally describe this as a wage price spiral. So in a wage price spiral, the natural outcome is that inflation is high. So for you as a worker, you realize that prices that you normally interact with, that is, let's say you're doing a household budget, you're buying food stuff, you're buying drinks, you're buying clothing, you're paying for fuel, you're paying for, let's say, education, health, rent, and all those expenses. You realize that they have gone up. So you go to your employer and you pressure them to increase your salary. So since the employer doesn't have a lot of talent and the labor market is very tight, so the employer agrees to raise your salary. So as they raise your salary, they don't want to take a hit on their bottom line. So they still want to make a profit. So as a result, they raise the price of their products. And then after you have received a higher salary, you go back to the market to buy the same goods, but realize that the prices have gone higher. So while the employer gives you on one hand, he takes on the other side from higher prices. So you find that the prices are higher. So you go back to the same employer, you request for even higher pay, higher earnings, and that spiral keeps getting higher and higher, which basically makes the inflation problem much worse. So to avoid this, the central banks have to be very tough on interest rates, keep hiking interest rates very strongly. And as a result of that, a lot of money finds itself out of the system. So the way this money flows out of the system is that with higher interest rates, you find that you're paying a higher mortgage. So when you're paying a higher mortgage, then you basically have less money to spend on other stuff. So your credit card debt goes higher. So you are paying higher interest on your credit card debt. So you're left with less money in your pocket. And at the same time, when you look at the bonds markets, the money market funds, they're offering really interesting returns. For instance, in the US, they're just slightly below 5%. So this means it encourages a lot of people to save money in the banks and of course to invest in money market funds. So when this happens and people push a lot of their money in banks and of course in the money market funds, the resulting outcome is that there is less money flowing in the economy. And as a result of that, you find that prices begin to stabilize and you achieve the goal of low inflation. So that's basically the goal that a majority of the central banks are trying to achieve, to control inflation back towards normal levels. So each central bank has its own targets. For the US, it's about 2%. And of course, for Australia and New Zealand, it's a range between 1 and 3%. So we have seen inflation become very sticky over the last couple of months. So with this very sticky inflation, for instance, the Reserve Bank of Australia, 2 months back, they had said that they have reached their peak interest rates. So they had decided we are no longer going to hike interest rates. But then, upon observing the inflation numbers, they made a surprise rate hike this week. So that was one of the biggest surprises this week. So if you look at the meeting from RBA early in the week, you'd notice the big surprise rate hike that they did. So this happened on Tuesday at 7:30 a.m., where the market was expecting the Reserve Bank of Australia to continue holding rates at 3.85%, but instead they made a surprise rate hike of 25 basis points, which pushed their overall interest rates to 4.1%. So the Bank of Canada had also promised the economy that they are not going to hike interest rates further. But then, upon realizing that inflation is getting sticky, then they also did the same thing. So investors were expecting that the Bank of Canada would maintain interest rates at 4.5%. As you can see, this is the expectation. But in actual sense, and this was on Wednesday, which is yesterday, they went for a 25 basis point hike. And as a result of that, interest rates moved to 4.75%, and the Canadian dollar as well as the Australian dollar became really strong. So if you look at the Forex performance, you'd notice that this week, this is for the last 5 days, the dollar has been the weakest currency among the major currencies, whereas these other currencies have been really gaining. So for Australia's surprise rate hike, the currency became the strongest among the majors, which has rallied 1.64% against the US dollar. So the Swiss franc is up 0.96%, and this is as a result of a meeting that happened earlier today, where the central bank governor, Jordan, basically mentioned that they don't have to wait until inflation becomes a bigger problem so that they hike interest rates. So what he basically noted or highlighted is that the Swiss National Bank, or what we call the SNB, is ready on its next meeting to go for another interest rate hike to make sure that inflation doesn't become a problem in Switzerland. So upon those comments, we saw a very big spike happening in CHF pairs. So I'll be showing you this in the charts. So this is, I need to see the USD CHF. Yes, so this is a chart of the US dollar trading against the Swiss franc. So clearly, you can see that the market has been consolidating for a while. So from this swing here, it made an upwards, downwards, up, down, up, down, up, down in what looked like a triangle. So on a longer time frame, you notice there was a very strong support line holding the chart here. But then eventually the market managed to breach that and drop all the way down after the speech by the SNB chairman. So since then, you can see the sharp drop in the US dollar against the Swiss franc, basically showing the evidence of the Swiss franc being really strong against the dollar today. And this kind of momentum is expected to continue, especially as long as the investors expect that the Swiss National Bank will go for a strong rate hike on its next meeting. So that's one key factor to consider in the markets. And this particular trend is expected to continue, especially after seeing the technical pattern here, but the market just cruised through the trend line, even without some form of pullback. So there is a good chance we'll be seeing some further downside here. So for the central banks that surprised everyone, which is the Canadian Central Bank, we saw what happened. So for Canada, after the surprise rate hike, you can see the sharp drop that happened here after the market was trading for 4 days straight on a sideways momentum in what looked like a flag. So the sharp drop happened here. The market pulled back, retested the area, went back downwards, and this afternoon the Canadian dollar attempted to move higher the US dollar attempted to move higher before the Canadian dollar strengthened further. And now you can see that the momentum is almost continuous. So if I was to extend this trend line, then it would be clear that the market has retested the trend line twice, and there's a good chance we will be seeing some further downside momentum happening in a USD CAD currency pair. So from the area where you are seeing the bounce, there seems to be some form of a conference. So this was the lowest support back in April, the support in May, and now the support in the current month of June. So there is a good chance we could be seeing the market retesting this support area and perhaps even breaking it towards the lower side. So if the US dollar was to strengthen as a result of a rate hike next week, then the overall reversal will be expected. So I will be expecting the dollar to rally against the Canadian dollar and perhaps even get all the way up to the previous trend line around 1.36540. However, if this doesn't happen, then we'll be looking at lower prices based on some past price targets such as 1.327. And of course, we have the lowest swing here being around, this is just a moment, 1.3224. So we could be seeing the price dropping to 1.3272 or 3224, depending on the next set of news that will be happening. And of course, that's basically next week. So tomorrow, the most important news that we'll be observing will be Canadian jobs data. So this could also have some form of volatility happening tomorrow. So if jobs are getting tighter, and I've already explained the tight job market scenario, a very tight job market would basically imply that the central bank has a lot to do, and that would be positive for the currency. So we would be expecting a very sharp drop here. So if the number of new jobs created in the last 1 month basically spikes higher, then we should be seeing the USD CAD breaking lower and pushing even below the support level. However, if jobs are smaller, that is, there is higher unemployment, it would mean that the economy is slowing down and the Bank of Canada is achieving its targets. So we could be seeing the market bouncing from here and maybe even going back to the 1.34078 level. So that's something to consider strongly tomorrow. So for the other central bank that made a surprise rate hike, this is the Australian dollar trading against the US dollar. So this was yesterday. So after the surprise rate hike, a very sharp drop. But now from the price action we are seeing, it was the day before yesterday. So this was the big spike after the news. So the Australian dollar really gained against the dollar. So pulled back in what looked like a triangle right here. Then after bouncing here, it kept going up yesterday, pulled back towards the evening, and today has actually recovered and gone through the previous high of yesterday. So there is a good chance we'll be seeing the Australian dollar continue to be dominant against the US dollar. So from the 4-hour chart, it seems like a very strong swing back upwards, and the target seems all the way up towards the previous high that we saw in the month of May. So it almost looks like a V-shaped recovery for the Australian dollar. So we could be seeing some further upside happening in Australian dollar against the US dollar. So this will probably majorly happen before the news next week, where we'll be following the FOMC press conference very closely. So besides the news that we're expecting next week, which is basically the FOMC press conference, there will be more content. There's, of course, the CPI. And we know that immediately after the announcement of the news, there will also be an FOMC press conference 30 minutes later. So while this happens at 9 p.m., FOMC economic projections, which is a report that you can read, FOMC statement, which is a report you can read, federal funds rate is a number. Then at 9:30 p.m., we will be seeing the FOMC press conference. So the beauty about the press conference is that during the press conference, the Fed chair, this is Jerome Powell, will be talking about the economic conditions of the US economy, the reasoning behind the rate hike or even holding rates. But the most important part is usually the questions. So there is journalists that are usually invited to the press conference. So immediately after the speech, they're able to raise their questions, and the Fed members have to answer the questions immediately. So as investors follow up on these, they'll get hints about ongoing monetary policy, So they'll be able to project what the Fed might do on its July meeting, and this causes increased volatility besides the volatility that comes from just the announcement of interest rates. So we also be seeing the ECB basically make an interest rate decision. So the ECB is short for the European Central Bank. So this will be happening at 3:15 p.m. and this will be on Thursday. So there will be the interest rate vote. In this case for ECB, the overall expectation is that there will be a 25 basis point hike, which would push European interest rates to 4%. So normally, whenever there is such consensus happening in the markets, it gets priced in earlier. So we could be seeing from Monday or even from Friday, the euro starting to gain ground against other currencies as investors price in the possibility of the ECB going for a strong rate hike. Of course, there will be a monetary policy statement, but more importantly is the ECB press conference that will be happening later in the day. That is 30 minutes later. So this case has a very similar outcome with the FOMC. So during the ECB press conference, we'll be looking at a speech from ECB President Lagarde, and of course, she'll be sharing hints about oncoming monetary policy. And of course, she'll be answering questions from journalists. So this will raise volatility on euro pairs. So besides this, there's also Japan. So there will be a third central bank announcing interest rates. So for Japan, it has been holding interest rate level at negative 0.1%, and we don't expect any change to be happening here. So nobody is expecting any form of surprises to be happening here. So the main focus for investors will be the Bank of Japan press conference, which will basically see investors' questions answered, especially concerning the rate of inflation in Japan, the point at which they are looking to change monetary policy. So if there's any hints that the Bank of Japan is looking to change monetary policy and maybe consider a rate hike, then in that case, could be seeing a strong Japanese yen. However, if this doesn't happen, then the overall estimation or expectation is that the Japanese yen continues being weak in the markets. So if you have any questions regarding the presentation, feel free to type those in the live comment section, and I'll be responding to those questions right away. So hello, Antoine. Hello, Dennis, Luca, Malombe. Hello, Samuel, Humphrey, and of course, Straw High Priest. I wonder what's your name. Kevin, thank you guys, and good evening, Kevin Minor. So I really appreciate when you guys attend these sessions. So whenever you have a question about the presentation, always feel free to type that, and I'll be responding to the question right away. So besides that, I don't think we have any other major news besides the Apple and Facebook launching VR headsets. So it's the newest tech in town, which basically allows you to experience a hyperreal form of reality with the headsets. You're able to operate between reality and virtual environments, where the VR headset comes equipped with features that allow it to be used as an entertainment device. This could be in terms of gaming, attending events, live virtual events. The metaverse, of course, will be incorporated in there. The PC or the personal computer will be something you can interact with from that platform. For your smartphone, it will also be incorporated on the platform. So it basically nullifies the need for all these other devices that you normally use. Now you have the one single device that you can use for everything, including the headphones and so on. So there will be key developments later next week in terms of the uptake of the products. So seeing how much interest there is in those products, and of course that may have an impact on how those individual stocks perform in the markets. So besides that, I don't think there's any other news that we're expecting to be very major next week. So now that we know that, you will be prepared to take on those opportunities as they happen. So as for tomorrow, I don't expect to be seeing much activity in the markets. So I think the major activity that we'll be focusing on will be just the Canadian jobs data. So this is a Friday. Of course, early in the morning, there is a Chinese CPI or consumer price index, which is a measure of inflation in China. So a slow inflation in China is very healthy for equities. So Chinese equities could be doing really well as a result of slow inflation. But of course, you know that they have been taking a hit as a result of slow growth in manufacturing as well as services sectors. So producer price index will also be a key indicator here. So a big spike in inflation and producer price index will be negative for the markets and of course for oil markets. But if it maintains at the current level, then we could be seeing oil markets rebounding. So Canadian jobs data at 3:30 p.m. Will be the most important data point. So in the previous reading, we saw the Canadian economy creating 41.4 thousand jobs. And of course, we're expecting a much smaller number of 21.2 thousand jobs. So if there's a big surprise here, and maybe the economy is really hot and let's say there's more jobs that were created in the last 1 month, then the result is that there will be an expectation that the Bank of Canada will continue hiking interest rates, which is very positive for the Canadian dollar. So we'll be expecting the Canadian dollar to strengthen. However, if this doesn't happen and there's a smaller number of jobs created, then in that case, we'll be expecting the Canadian dollar to be really weak. And that's the overall consensus. So the overall unemployment rate is expected to rise from 5.0 to 5.10%. So that's it. That's the end of the presentation today. So we'll peruse across a number of charts and see what to expect. So I don't think there's major things happening besides the recent volatility in gold. So gold was really volatile this afternoon after being quite quiet for the better part of the day. So from the Asian session and the London session, there was not much activity in the markets. But once we go to the New York session, there was a big spike all the way up. So the target here was 1964. The market managed to go all the way up to around yesterday's high, around 1970. And once it got this to this point, there was a strong rejection. And what we're experiencing now is the price being unable to break that level and moving back downwards. So we could be seeing a lot of these to and from momentum happening in the charts up until we have the CPI data in the US, as well as the FOMC press conference. So for the last 4 or 5 days in gold, I would say the overall direction of price has been sideways. So yes, we have some pretty decent swings that are worth trading because they have quite a good number of pips. So if you're able to capture any of these swings, let's say from here to here, you can notice this is around 298 pips, or basically 2,983 points. So these are quite an impressive swing happening within a day. So if you're able to capture some of these movements, then by all means get to take advantage of them. So for now, it seems like an upswing downwards. So maybe you could target the pivot point or basically the mid level of these. So a very shorter term target is going for the mid level, and this would be somewhere around 1953 price level, following the recent momentum upwards. So besides these, USD JPY made an impressive break towards the lower side. So after trading within a triangle for all these number of days, around 10 days, there was a sharp break towards the lower side. So it implies that we're expecting some further downside. And of course, for USD CAD, this is some further downside. We've already discussed this today. So AUD/USD upwards, equities making an impressive comeback here after the big sell-off yesterday. So the Nasdaq 100 has been quite bullish today. The S&P 500 made a good swing. So we are still trading within the flag, got to the upper trend line. And maybe perhaps if you are in a buy position, it may be time to take profits since the market is expected to maintain this kind of momentum up until we have the data point coming from CPI as well as the FOMC press conference next week. So as for the Dow, it made an impressive run upwards, got to the target resistance. So our target was 33,837, but upon reaching here, we can see it's almost forming a rejection. So perhaps some further downside will be happening since there's no more pressure or upwards momentum from this chart. So as for Brent oil, it was pretty violent this afternoon. So after trading along this trend line and finding support here, so we saw the market forming this particular triangle. So if you look at the series or the sequence of highs here, it was a market that was basically oscillating between this and up and down and up, down, up, down. So this morning, during the market snapshot series, we saw the market going back downwards, and we were expecting a bounce, which actually happened, and the market got to the upper trend line, and then in the afternoon broke the trend line and made a very sharp drop. But then in the last 1 hour, we have seen some very impressive recovery, and right now the market is well on course to make a full recovery. So full recovery is just here. So we expect the market to keep going up and get to the previous point before the breakout. So it seems like we will be seeing the price get to $76.49. So there is a lot of speculation that the US is tapping more oil from its strategic oil reserves, which currently seem very low. So while on one hand, the US tapping on its strategic oil reserves implies that there will be downward pressure on price, investors are betting that you guys cannot extract even more oil from your reserves because you don't have any, you don't have a lot of oil to pump into the markets. So it's very short run. The market is basically questioning the US, telling it that you cannot manipulate prices downwards because you don't have sufficient oil. So you must buy oil from the markets in order for you to be able to manipulate prices. So as long as your strategic oil reserves are really low, then you might not be able to do what you are doing a year ago. So in this case, that's why we are seeing a very strong recovery here. So USDCNH, this is the US dollar trading, and it is the Chinese yuan. So it maintains the strong bullish momentum that has been happening over the past couple of weeks. I would say from mid-April, this particular chart has just been moving upwards. So whenever you get these pullbacks, it's always an opportunity to go long. So I think this today's bearish momentum is very much welcome for people who are looking to trade the pullback. So whenever there's a pullback, then you go for your long positions. So New Zealand USD made a very impressive pattern here, which looked like what I would describe as an inverted head and shoulder. Hasn't been completed yet. So the completion is expected to happen once the market gets back to the neckline. So this did not quite complete. So the immediate expectation is that the New Zealand dollar continues to rally against the US dollar and eventually completes the pattern, which would be the basis of a reversal. And now we'll be expecting a break of this trend line and some movement higher. So as for European equity indices, we know that they have been pretty strong. However, from today's readings from the European GDP, we know that in the first quarter of this year, the European economy contracted by 0.1%. And in the last quarter of last year, it also contracted by 0.1%, despite previously reading a gain of 0.1%, which was revised downwards to negative 0.1%. So whenever you have two consecutive quarters of GDP contracting, then it's basically official. Apologies for that. So it's basically official that the economy is in a recession. So right now, it's official that the European economy is in a recession. So last week, we saw Germany GDP, and it also confirmed that Germany is officially in a recession. However, for the Eurozone, it's a very mild recession because in both quarters, the GDP contracted by a very small number, which is close to zero, at 0.1%. So the result of this is investors adjusting their beliefs about the market, and in this case, counting in a potential bigger recession, especially once we consider the next data point, which is the next quarter. So on the current quarter, we'll be seeing the results next quarter. So if there's a further contraction in GDP, then we'll know that the recession is getting worse. So it's not worse as of right now. However, in terms of equities, we could be seeing them start to go back downwards. So notice on the daily chart how the Euro Stocks index was unable to form higher highs and now has been maintaining here after forming the double top. So it has been going up and down, up and down, up and down. But in all these sequences, you will notice that the highs are getting lower and lower, basically indicating a very technical pattern that the price could eventually get back downwards to the previous low. So in this case, the overall consensus here is that there is a good chance the Euro Stoxx index will be dropping further back downwards towards the lower trend line. So this is something that you should actually consider, but it's not a recommendation to trade. So that's it for the day. Thank you very much, guys. Thank you for your time, and I hope to see you on the next session. So hello, J Squad. Hello, Malombe. Learned a lot about effects of inflation. Thank you. Hello, Tony. And of course, hello, I'm free. Thank you guys for your feedback. See you on the next session.